All right, good morning, everyone. Welcome to Financial Fridays with SAANYS and Equitable. Today's topic is tax time, plan accordingly. SAANYS is excited to offer these sessions in cooperation with our corporate partner, Equitable Advisors. Equitable has a long-standing presence in New York, and a large portion of their client base is built upon the work they do within the public education system. Through Equitable, SAANYS members can receive competitive insurance rates and a full array retirement services, including a complimentary financial profile for senior members, which we urge you to take advantage of. This is a great benefit for membership. Joining us today from Equitable is Joseph Scrow. We'll save questions until the end of presentation, but feel free to add your questions in the chat at any time. Our Q&A time is best used for general questions, but please note that your Equitable team is available at any time to answer your personal and confidential questions. You'll find contact information for Joseph and other regional Equitable representatives at saanys.org. And I will turn it over to Joe.
All right, thank you. Happy Friday, everybody. Hopefully everybody's doing well, getting ready for the weekend. I know we had some crazy weather here in central New York. It was absolute blizzard here in Syracuse, and now, it's going to be 55, 60 degrees this weekend, which is kind of crazy. Today, we're going to be going through taxes. So I know this is everybody's favorite conversation, right? Talking about taxes. So really today, the agenda is going to be going through high level overview of taxes. Now, one thing I always like to say when I'm meeting with individuals or businesses and we're talking about taxes is, if you have a specific situation or a special scenario, it's best to talk and discuss that with a CPA or a tax accountant. Yes, we're financial advisors. We do the best that we can for minimizing taxes, which we'll talk on today. How do we reduce tax liabilities? But for those really special scenario situations, you really want to work with a CPA, a tax accountant, in order for that. And we have great referrals and people that we work with, all across central New York. So if you do have a specific question for somebody, we'd love to get you connected there. But really today we'll go through again, high level overview of taxes. So really, what are the current tax rates when you go to file your taxes for 2023? How is it different from 2024? And then different strategies as far as, well, how can we reduce the tax liability in today's year, but then also down the road. So we'll start off by just taking a look at 2023 and the different tax brackets based off of how you're going to file your taxes. So again, in 2023, the tax brackets actually did stay the same. There were no changes. So the different brackets that somebody could fall into, as you can see right there on the screen, 10, 12, 22, 24, 32, 35, and 37. Those percentages stayed constant compared to 2022. But the actual numbers and the income ranges did increase as they do expect over time. So we'll take a look at, really what are those income brackets based off of how you're filing your taxes. So if somebody is a single filer, as you can see at the top right, those are the different tax brackets with the taxable income that you can see there. The types of income that we always take a look at are earned income, unearned income, and investment income. Those are all different factors as far as how they can change the different tax brackets that you do fall into. Another common one that we always typically see, married filing jointly. So you can see those income brackets or the income numbers there on the right-hand side. Those all doubled, factoring in two people filing their taxes there. Again, they take a look at the unearned income, earned income, and the investment income. But we do get a lot of questions from clients as far as, excuse me, difference between married filing jointly and married filing separately. Now, again, this would be case-by-case scenario, but generally you do lose tax credits and tax benefits if you do file separately. Now, there are certain situations where maybe it does make sense to file separately from your spouse. The number one thing that I can always think of when it comes to, should we file together, should we file separately, are really going to be the student loans that we are in. So if somebody is in some sort of a student loan forgiveness program, and it is an income-driven based plan, So if it is the PSLF, or if it's the teacher loan forgiveness, or any really sort of forgiveness program federally that your monthly payments are based off of your income, then it probably does make more sense for the spouses to file separately to keep that tax number and the income number as low as possible. But you can see some of the benefits, right? You can get some higher deductions based off of your adjusted gross income. But again, some things to consider is you're definitely going to lose some benefits, right? So what could be lost if you do file separately? It could be some child or dependent tax credits could be lost, the education tax credit, right? Some student loan interest deductions could be lost there. So again, this is one of those examples where it could be better to file jointly, but then also too, on the flip side, maybe it makes more sense to file separately. And that's what we do. We go through a process and seeing which one is going to be best for somebody's situation. The other way that somebody can qualify or file their taxes is head of household. So again, this could be unmarried or in the stage of separation. There are some qualifications as well of just being unmarried, right? 50% of the household expenses must be paid by that head of household. You do get a higher standard deduction versus filing single, which is nice. So if you are somebody who is head of household, you have some dependents in the house, you can have a higher deduction. But then you can see on the right-hand side there, it's also going to be higher income levels to hit some of those tax brackets there too. So again, we take a look at that. The difference between head of household versus single file. Does it make more sense to file this way versus that way? And we work in collaboration with somebody's tax accountant or CPA there. Now, this is definitely a question that I've been getting a lot from clients over the past few years is how do tax brackets really work? So if we take a look at a simple case here, right? Let's say Jane, she has $58,000 of taxable income for the year. So she filed her taxes. It was 58 grand after the standard deductions, or maybe she itemized her taxes. And that would qualify her for the 22% tax bracket. Would she have to pay 22% on the entire $58,000 of taxable income? A lot of people would say yes, but the answer is actually no. So the way that tax brackets and paying for those liabilities work are there different stages as far as what portion of that entire amount is actually taxed at those different levels, right? So if you see at the right-hand side there, or again, assume that Jane has $58,000 of taxable income that she has to pay for. The entire amount is not fully taxed at 22%. 0 to the first 11,000 is going to be taxed at the 10% level. Then anything above 11,000, so $11,001 to the 44,725, that's going to be taxed at the 12% level. And then again, as you can see, from 44,726 up to the 58,000 mark of what she does have to pay is going to be taxed at the 22%. So again, it's a very big misconception. A lot of people do think, well, if I fall in the 22% bracket, then I have to pay 22% taxes on everything. It's actually not the case. It's based off of the stages as far as where you do get. So if somebody were to get bumped, let's, for example, look at that table there from the 22% tax bracket to now the 24%. So let's say that, they had a bonus check come in from work and now they're sitting at $96,000 instead of the 95, which is the top range of that tax bracket. They'd only have to pay that 24% off of whatever is additionally above the 95,000. So it's not as bad as what it seems, right? It's based off of the different stages that you can see there. Another question that we typically get as well is when I file my taxes, should I take a standard deduction or should I maybe look at itemizing my deductions? And again, everybody's different. It really depends on what sort of expenses or purchases that you made throughout the year, right? So as we know, the standard deduction is probably the most commonly used when filing taxes across the board. If somebody is single or separated, $13,850 is going to be the standard deduction that somebody can take and deduct from their taxable income there for their incomes or salaries. Jointly, it's actually $27,700 is what they can deduct. And then head of household, like we said, it's a little bit higher than the single filer, $20,800. Now, looking at the bottom left there, if somebody did have maybe some medical expenses or taxes that they paid or interest paid that is above their single, jointly, or head of household standard deduction, then they could add up all those different expenses and take a higher deduction from their income tax. So maybe somebody had a really big medical surgery. Maybe it costed, $30,000 and they were filing jointly together. Well, they could actually take that medical expense, and if it is higher than their standard deduction of what they currently usually take, then yeah, they can go ahead and itemize those deductions, lower their tax liability throughout the year. Commonly used tax forms that we typically get, right? W-2 is probably the most common, right? Being a part of an employee, whether it's an organization, for-profit company, non-for-profit company, you get the W-2 in the mail, you utilize that form to go ahead and file your taxes. But there's also a couple other ones, 1099. So if somebody is self-employed and they do earn $600 or more in that current year, they will receive a 1099 from that institution, right? So maybe somebody works part-time as a self-employed consultant, let's say, or maybe somebody is doing something under the table, or maybe they did a contracting job in the summer, right? Whatever that ends up happening, if they did end up earning more than $600 for that current year, then they will receive a 1099 form and they'll have to pay taxes on that income. 1098 form, it's more so for interest on mortgage or student loans. You can write that off as well, up to certain percentages. So if you are paying student loans back, paying your mortgage back, that's probably the most common one. You can go ahead and write that off your taxes as well. Now, where do we come into play, right? So being a financial planner, financial advisor, right? What do we look to do for our clients? We look to minimize risk and maximize returns, right? So very similar to the tax world and tax situations, how can we reduce your taxable income so that we're making more money on a year-over-year basis and enhance what we can do with that money, right? So this is what we spend a lot of time with our clients on, is how can we reduce somebody's tax liability? I always like to say there's a lot of smart people. There's a lot of people smarter than me out there in the world, right? Anybody can put you a portfolio together, right? If it's for your retirement, your 403B, deferred comp plan, right? Anybody can put together a portfolio that could get you an extra 2, 3, 4% rate of return on a year-over-year basis. But where people really save the most amount of money is how can we pay less taxes, right? So some ways that we can reduce somebody's taxable income, number one is saving into a pre-tax retirement account. If we really have the capability to increase or maximize our retirement accounts, that's definitely going to be a huge way for us to defer income. And instead of paying back New York State or the federal government, we can pay our future selves in the form of a 403B, deferred comp plan, IRAs, right? Anything of that nature. So utilizing those pre-tax retirement accounts is definitely going to be a huge way that we can save money either today or down the road for tax time. Now, we can also utilize health savings accounts or flexible spending accounts. HSA plans are really the only triple tax-free investment out there where you can make a contribution pre-tax. So you get the tax break today, the money grows tax deferred. And then if you were to take distributions from that account and utilize them for qualified expenses, medical expenses, then it's tax-free. So it's really the only triple tax-free account or investment out there that people can take advantage of, right? You save money tax-wise on the contribution, but then you also save money tax-free wise when you go ahead and make that qualified medical expense. Some other ways that we can take a look at just reducing our tax liability, charitable donations. So if you do make any sort of donations to charities, you can write that off. The maximum amount is $300 for single, $600 for married in 2024. Also, being in the educator space, you can deduct $300 from your tax return as well in 2024. So that's always something too to take note. A lot of people don't know about the charitable donation. So, I mean, again, if you have a favorite charity in mind, or maybe you go to church, you make donations, right? It's a good thing to write that off on your taxes. There's also a bunch of different tax credits that people can utilize as well. As you can see, there's the long list there. Now, one of the tax credits that has been kind of fluctuating over the course of the past couple of years is the child tax credit. That's something to note, that if you do have kids who you do claim as dependents come tax time, take advantage of the child tax credit. Do want to make note that you may be losing that tax credit depending on their age and if they are getting older. I know COVID really messed up a lot of people's tax returns, not 2020 or 2021, but 2022 and 2023. So again, it's all dependent upon your kids, their ages, what that looks like. So we can always dive into somebody's specific situation and seeing if they are going to lose any sort of tax credit now that their kids are getting older. But again, all these different ways are ways that we can really reduce our tax liability so that more money is working for us in the form of retirement accounts, investment accounts, savings accounts, right? All those different ways of how we can really benefit. So now as we take a look at, retirement plans specifically, right? We said we can utilize these in a bunch of different ways. That first section there, utilizing 401k, 403bs, 457 plans are definitely going to be a way to do that. Now, for the pre-tax, it's like we've been talking about, you make your pre-tax contributions. You get the tax break today, which is nice. The federal government does say if you are going to save for your future self, we will give you that tax break today. The money does grow tax deferred. But come retirement time, when you do go to take that money out, it is going to be taxable, definitely at the federal level, sometimes state level, depending on how much you do take out. Okay, so that's a big thing that we take a look at for a lot of our clients as well, is seeing how do we save on state taxes and staying within the range that we can take distributions from our qualified retirement plans, but not paying state tax. Another thing too, if you take a look at the third box there, some plans may offer Roth contributions. This is becoming a little bit more popular in the more recent years, is taking a look at, well, should I do pre-tax contributions or should I do Roth contributions? Pre-tax, more so the traditional route. The Roth way is the complete opposite of pre-tax. So like we were just talking about, pre-tax, you get the tax break today. The Roth contributions, you pay that small tax today. So you don't get any tax benefits today. The money still grows tax deferred or tax free in the Roth case. But then come retirement time, when you do go to take those distributions out, they're completely tax free. So again, we take a look at people's specific situations and we say, does it make more sense for your tax liability, but then also your future income down the road with pensions involved, Social Security involved, that we should be saving pre-tax today, or should we be saving Roth contributions today? I think there's a slide later in this that we can go ahead and dive into that a little bit deeper. Also too, we want to take a look at contributions. So kind of like how I mentioned earlier, if you do have the capability of maximizing your contributions in your employer retirement plan, definitely encourage you to do so. Now, everybody's situation is different, right? Some people can, some people can't, just depending on current living expenses. But really saving up as much money for your future self is definitely going to be the best route moving forward. And it could, of course, save you taxes. So how do we take advantage, right? Like we were kind of talking about, really the goal is for us to reduce current income taxes, future income taxes today and tomorrow. So we take a look at your current situation saying, are there any ways of us decreasing our taxes? Maybe it's increasing contributions, or maybe it's opening up that HSA plan to start utilizing those funds tax deductible as well as tax-free down the road. Maybe you have a huge liability. So if you do usually come tax time, cut a check for 5, 10, 15 grand, maybe it makes more sense for this year to do some pre-tax, right? If you were previously doing Roth contributions, right? So we take a look at all these different factors for the clients that we do service, and we say, well, how can we really take advantage of this, not only today, but then also down the road as well? That last box right there, prevent taxes and penalties. We definitely want to have accounts and strategies set up where we're not doing too much money in our long-term buckets, right? Because of those pre-tax benefits, right? Let's, for example, say that somebody's still 5, 10, 15 years away from retirement, and a situation comes up where they need a lump sum of money that they don't really have liquid on cash, right? We don't want to be in a situation where we now have to take distributions from our long-term investment accounts, where now we have to pay IRS penalties on top of the federal, state taxes as well, because that's really going to decrease the value of our money in that current time frame. So having different buckets of money set up where we have our short-term savings checked off, we have our long-term savings checked off, but now it's really what happens between that, right? What happens in years 2 to 15, where if something does come up, do we have some sort of a strategy to pull money from to avoid any sort of taxes or penalties associated with that as well? So here's a good example of really how pre-tax retirement savings work. So for those that have set up retirement accounts, 403B, 457, right? If you sat down, you met with an advisor like myself, they probably explained to you that the power of pre-tax savings is really good, right? You get the tax break today, but then also too, because it's a top line item that comes out of your paychecks, it really doesn't feel like that money is missing from your paycheck. So good example, let's say somebody wants to contribute $500 a month pre-tax into their retirement accounts, right? So I know for a lot of, educators get paid twice a month. So let's say per paycheck, $250. Well, because it is $250 on paper, it's not going to feel like $250 missing from your take-home pay, because you have to factor in the pre-tax benefit and whatever federal tax bracket you do fall into, right? So in this example, let's say somebody was doing $250 per pay, so that'd be $500 per month. And let's say their effective federal and state income tax rate was somewhere around 25%. So if they're doing $500 pre-tax, you do have to factor in those taxes. So what's it really feeling like coming out of their paycheck is only $375. So it's nice because we're putting the power of our money to be invested more so in our retirement accounts than in our checking, savings, or maybe after tax accounts that we do have already set up. Now, the difference from pre-tax to Roth, that's actually right here on the next slide. The difference between the pre-tax and the Roth is if you wanted to do $500 per month, let's say, or $250 per paycheck, it's going to feel like $250 missing from your paycheck, because that comes out at the bottom of your paycheck for that net monthly income. So you pay that small tax today, but for the benefit down the road of having that tax-free growth and the tax-free distributions on the back end. Now, a lot of people do have their different opinions, right? Some people say, well, I like the pre-tax, I get the tax break today. Down the road, yes, I'll have my pension, but depending on how many years of service that I put into the state retirement system, right? If it is 30, 32, 34, I'm not going to be making as much money. So I may be in a lower tax bracket. Well, that may be true. So maybe it makes more sense to do pre-tax savings. Or maybe somebody comes from a family, maybe their spouse also has a pension, so their incomes are still going to be pretty high. Yes, they may take some reductions, but now when you factor in your federal pensions through the state, as well as Social Security, your tax bracket could be a little bit higher, or it could be in the same bracket. So maybe it makes more sense to start saving Roth contributions, Roth savings. So then when you do go to retire, you can take that money out tax-free. Again, everybody's different. What's a good idea versus going pre-tax or the Roth is maybe do both, right? Most 403B plans like ourselves, we have the option to do both. So we can have a pre-tax bucket of money inside that 403B, and then we can have Roth bucket of money inside there. And then we could do a split, maybe some pre-tax, some Roth to get the best of both worlds there to kind of minimize risk across the board. So just some points to remember, right? And the first bullet point really says it all. It's really important to constantly review your financial plan with a tax accountant, CPA, financial advisor, right? Because things change. Tax credits change, tax rules, laws, regulations change on an every year basis. So it's really important to manage not only your tax situation, but also your financial planning situation to see, are there any areas that we can take advantage of that maybe we weren't doing already? We find a lot of people, they start making more money, which obviously is fantastic, right? We want to keep increasing our income and our savings, but if that starts creeping up into another tax bracket, if you take a look at the net income that we actually receive based off of after paying taxes, union dues, FICA, all that good stuff, are we actually making more money or are we just paying more in taxes, right? So it's always good to do an annual review, right? Sit down with your CPA, your tax accountant, sit down with your financial planner, really go through your current situation on a yearly basis, preferably twice a year, so that if there are any updates to the tax laws, then you can go ahead and take advantage of that, pay less in taxes, have more money in your pocket at the end of the day. It's a win-win moving forward. So one of the ways that we're able to do this specifically with the people that we meet with is our financial planning software called Asset Map. Now, I know some people might have seen this before, but this is our financial planning tool, software, resource that we utilize for all of our clients, not only for the tax situation, but then also for retirement, general investments, pension options, right? Anything really financially we're able to put into this program. Now, we always like to meet with the household, right? So get your spouses involved, right? Sit down with them. Most scenarios, people do want to retire together. So if you do want to have your spouse involved, it's definitely a better thing. But at the end of the day, we want to see somebody's situation to see, are there any opportunities or are there any gaps within their plan that we can go ahead and make some recommendations to, again, pay less in taxes, have more retirement assets, have more net income that we can increase our savings, our spending, right? Whatever that looks like. And the way that we're able to analyze this, once we have all the information inputted into the software and into our database, then we go ahead and we utilize what's called target maps, which is our forecasting and projection tool to see, are we on pace for meeting our goals today, tomorrow, but then also down the road. One of the factors that I know today's topic is about taxes, so I'll stick on that. But one of the factors that we always like to consider are taxes in retirement and how working with different tax brackets could end up changing our income on that monthly or on that annual basis. So we can play around with different tax numbers and tax brackets in retirement, which a lot of people do enjoy. So we can run different scenarios, projections for everybody to really see, are we really maximizing our situation here, or are there any opportunities that we can go ahead and take advantage of? So this would really be part of our financial planning process, sitting down with somebody, getting to know them. And then once we have a full picture of what they're currently doing, then we can make the recommendations. It could be a quick, easy fix and seeing, what changes or what ideas do we have to benefit your situation. Okay. So that's all I had today. What I will do is I'll stop sharing my screen here. I think I did see a couple of things in the chat. Will this slide deck be available to us? To be completely transparent, I'm not sure if I can share this exact slideshow, but what I could always do if I can't, then I could always send out some more information and some more tax PDFs documents, some more marketing pieces on just some of the strategies that we did talk about here today. So after I can get a list, and then I can go ahead and mass email out email that out to everybody. So we can go ahead and do that. The $300 for charitable donations. Yes, that is the total max deduction. So you can only deduct $300 for that current year for charity donations. That is the maximum there. Somebody else asked if this is from the actual income from your work, or maybe it's also income from investments. It would be everything put together. So like we said, the three areas that they look for income, it's going to be earned income. So that would be from your work, passive income. So that'd be from real estate, right? As well as any sort of investment income. So that's also plays a factor. Now, investment income and the way that it's taxed, it's going to be taxed a little bit differently. You'll get that form to file that, and it will say right there what your tax liability is based off of your income brackets there. Somebody is asking questions about 529 plans and how that is deducted. So again, you should get a form in the mail from the institution on where you are saving for 529 plans. Now those are going to be state tax deducted. So what we went through were the federal income tax brackets. Now, when you go to file your state, you would also put that you made qualifying contributions for your kids in 529 plans. So if you do your 529 plan through JP Morgan or I think Morgan Stanley has a plan, or American Funds, definitely want to log into that portal to get that tax form, and then you could utilize that contribution and that tax deduction when you file your taxes. But that's going to be only state deducted, not federal tax deducted. Somebody else in here pulled something up from the IRS website. Now, I'm not familiar with that specific ruling on the number 506, but I can do some more digging and reach back out to you after if that works and seeing that. Oh, yep, it was in the Q&A here as well. So perfect. Yep. I can do some more digging and reach back out on a mass level and seeing what that looks like. Okay. I think that was all the questions here in the chat. But what I can do too, I'll reshare my screen here. Now, again, a lot of tax situations here, it's all case by case analysis. So if you do ever end up having a question, or if you would like to see your current situation in our asset map program, and then we could give you some new ideas of how you can be decreasing your tax liability or increasing any sort of investments or retirement portfolios. There's some of my information there. We jot down my email, joseph.scrow@equitable.com, as well as my work phone number there. Reach out to me. We don't charge for our time. I think that was a question when I was on last time. Somebody asked. It's completely free to go through the financial planning process and to see your situation, for us to give you advice and guidance. So we don't charge financial planning fees or anything like that. So it's only beneficial to your situation to see, what you're currently doing and if there's anything that you can adjust there as well. Okay.
Looks like a question popped up, Joe.
Oh, okay. Let me go ahead and go back to this. New York State tax benefits on 529 plans prorated based on income. I don't believe so, to be completely honest with you. I think it's not prorated based off of your income. Sorry, my lights just shut out there. But again, I can double check that and seeing if anything has changed in the past.
Okay, thank you. If there's not any other questions, Joe, you did give your contact information on that last slide, and this will also be posted on SAANYS website on the YouTube channel. So you can also go to SAANYS.org And you'll have all this information here. And thank you again for presenting.
Yep, absolutely. Thanks for having me. Hopefully everybody has a great weekend.
Thank you. Have a good weekend.
Bye.